carrying a large balance on your credit cards or have built up a big pile of other debts, you may see borrowing from your 401k as a quick and convenient way to wipe out those obligations and save on the interest expense. And in some cases, such a move could make sense. If you're paying a high rate on your current loans, you may be able to cut your costs by borrowing from your 401k and using the 401k loan proceeds to pay off other loans. Repayment terms vary from one 401k plan to another, so you'll need to check yours to see what terms it imposes and to assure that your plan even allows loans, which most usually do. Typically, 401k participants can borrow 50% of their account balance or $50,000, whichever is less, and repay the loan through payroll deductions over a 5-year term. The typical rate is 1 percentage point above the prime rate. With prime recently at 3.25%, that would translate to a loan rate of 4.25%. But while that may make borrowing from your 401k seem like a no-brainer, there are a number of things you should consider before taking out such a loan. One is that if you lose your job or move to a new one, you will likely have to repay your 401k loan within 60 days. If you fail to do that, the balance you didn't pay back will be considered a distribution on which you'll owe tax and possibly a 10% penalty. What's more, some plans don't allow you to make additional contributions to your 401k while a loan is outstanding. If that's the case, you're not only likely to end up with a lower account balance at retirement than you would have without the loan, you'll also end up with a higher current tax bill because you won't have 401k contributions lowering your taxable income. Even if you're okay with these potential drawbacks, before tapping your 401k for a loan, you should see whether there are comparable or better options out there. Admittedly, finding a lower rate loan may be tough if your 401k is charging 1 over prime, but you might be able to come close with a home equity line of credit. For rates on this type of loan, you can check out the home equity section at bankrate.com. Indeed, even if the home equity rate is a little higher, you may still be better off since interest payments on this type of loan are typically tax deductible, while those on 401k loans are not. To see if home equity interest would be deductible in your case, you can check out IRS Publication 936 on home mortgage interest deductions. As a rule, I don't like to encourage people to think of their 401k as a piggy bank to dip into or borrow from. Using it that way can conflict with and undermine your 401k's true purpose, which is to provide you with a large enough nest egg to support you in retirement. Which is why I think most of the time you're better off finding a way to get out of debt without raiding your 401k. That can mean stepping up payments on the debt you already have, or replacing current debt with a home equity line or other loan that has a lower rate or better terms. Better yet, you could do both. But if you do decide to borrow from your 401k for whatever reason, then be sure to plan ahead about how you'll handle the situation should you leave your job and find yourself having to repay the loan balance much sooner than you expected.